welcome back, everybody, to Money in the Tank, episode 35. More topical information today to talk all things finance with you guys, have a bit of fun along the way, and hopefully make it nice and easy for our listeners and viewers, whichever format you may be watching us on, to follow along. Any questions at all as well, reach out. We've got some good Q&As today. Unfortunately, Rivkin's not with me, which is a real shame. I haven't told the boys yet. I didn't want to let them down early. So we may have to miss that section today. But
I'm Googling right now. We never miss a Rivkin's rules.
So we've got some great Q&As today. We got really good topical information with all things interest rates that are going on around the world, flowing into that with inflation as well. The kind of craziness going on in the stock market at the moment and what that means and how that all works. The Q&As are actually relating to that in terms of the market slump, which we'll cover off on later on. Bit of crypto news and any other hot news items with Arnie for his rapid fire rundown. But Arnie, where can the tankers get at us if they have any questions, they want to follow us or subscribe to us?
Yeah, please do subscribe, like, comment, and get us at Money in the Tank on YouTube, Facebook, Twitter, and Instagram. And I've got to be more active on Instagram, but yeah, but get us on those, guys. And
awesome.
I got a Rivkin's quote.
Earn your subscribe, but yeah, we're out every week, so.
Yep. Without further ado, as well, Joel Seach, Principal Advisor, Harpel Financial Group, Arnold.
Yeah, Arnie, tax professional,
and Brad Tabone, generalists.
All right. Rivkin's rules. I got a few here, but I've just picked out one which I think is interesting. So charting. As in, like, I think he's talking about technical analysis here.
Yeah, he never liked chartists.
Yeah, so the quote is, charting is useful only for one thing as far as I'm concerned, and that's to show you where a stock has been. As for showing you where a stock is going, that is absolute garbage.
There you go. Yeah.
Couldn't agree more.
Good one. I don't know, chartists, is that still a big thing now? Like, I know people that kind of talk on being chartists and they look at charts and
Fibonacci, freaking bands and all this sort of stuff.
There's people refer to it as astrology for men, which I think is one sexist, but also very funny. But I know that there's like certain trading now that will look at the percentage chance it's going to hit a band either up or down, like on a particular stock. And I don't know enough about like the statistics and the log scales behind it, but it just sounds like advanced charting, which is all bullshit.
Mate, all the models that show you whether it's the rainbow, whether it's the green and red and the bands, and shows you if it hits this, it's going to go along the rest of it. I mean, they're all just it's just models and numbers. Yeah, really. I mean, it used to have some basis back probably in the 80s and 90s when models were coming out to track human behavior and stuff like that. But as soon as like high frequency trading came in and like way smarter quantitative analysis and hedge funds, no.
Yeah, it's all
like
algorithm
a human
driven.
charting versus like what's happening like with high frequency tradiing. No, good luck.
Yeah.
Ever. But no, I agree. Rivkin, for once,
I think he was more of a fundamentalist, Rivkin, and he sort of, I think he liked to buy on mergers and acquisitions, and he didn't really like.
Buffett's a fundamentalist as well. Always says that he's never timed anything. He's never knows where the market's going to go up or down. He's just kind of bought at the right times. Buffett,
yeah.
Well, just bought. He just literally looks at the company. Doesn't even care what's happening with the economy. He just looks at the company and looks at the metrics and goes,
It's an interesting one. I was probably going to bring it up with the Q&A a bit later, but I'll bring it up now. That I was actually thinking of the car riding this morning that Buffett, I don't know if you guys remember, we spoke about on the podcast probably about a month or so ago. He whacked in a large purchase of some significant stocks about a month and a half or so.
40 billion. So he put in $2 billion between January and February, and then between the end of February and March, he slotted in $40 billion.
Yeah,
which back in 2008 when he did his kind of big buys at the bottom, and everyone was like, "Wow, he did." I think he bet 20 billion at the time, and that was huge money for them. And this time he just slotted
in the bank stocks and
and also into GE. GE, and this time around he slotted in that big 40.
So it goes to show that even the quote unquote best investor in the world, over history, doesn't try to think or time that there's going to be a dip or a crash here in this month of June, or there's going to be a really 10% swing in the S&P over the past 5 days. He doesn't know that. He probably doesn't care that much either. He says
he doesn't care.
He looks at the fundamentals of that stock at that time that he wants to buy in, and he feels that that's an undervalued stock, irrespective of what the market does in the next 12 months.
Yeah, basically looking at 5, 10 years, 20 years horizon. I mean, they've it's an interesting way, and it's not easy.
It's almost a cliche at this point. Like, I think it's really good advice from Buffett and Munger to say, like, look at the company, look at it like you're owning the whole of the company, look at it like you want to hold it forever. But the interesting part about their trading or their 13F filings every quarter is they're constantly moving in and out. So the caveat is, like, yes, it's a very good mindset to be in when you're investing, but you should always be analyzing your businesses and their fundamentals relatively often, so that if something changes, like a high debt load as an easy example, you can move out of that business before, like, if it becomes too risky for you.
I think, Arnie, like you said, it's something that it's an active instead of a passive kind of investment strategy.
Yeah, it's an interesting one though, because when you're new and you're coming to the stock market, you go, oh, okay, it attracts people because it's simple. It's like, okay, I buy and I hold forever. And I feel like you just need to temper what Buffett says sometimes with, yes, if nothing changes. That's the key to it.
I'd imagine there's some stocks that he's held for a long, long time.
The majority. I mean, some of his big plays he's held for a very, very long time. He's got some wrong, like, the Kraft-Heinz merger was bad. Some stuff, but I mean, the majority of the time he does hold. So he does trade in and out, but the majority of his holdings he does actually keep for the long term in a lot of the companies that he makes big bets on. So
yeah, I know one that springs to mind is Coke. He's had that for a long time, Coca-Cola. Another one, I think he might be in one of the banks. He was in a lot of the banks and he sold out of a lot of them, but I think maybe Bank of America he might be still in. And Apple he's been in since around 2016, so getting up there for how long he's held that.
I think the key for me is, and it's something that I've tried to practice over the last probably 10, 15 years and only getting okay at it now, is not to get caught up in the emotions of the market.
Yeah, that's
very hard.
And not to try and pick the bottom. So for instance, like when we talk about the kind of viewers question later on.
Mate, I'm doing it now. I'm breaking pattern.
Let's go. Q&A.
It's too topical for a question. So Charles wrote into us, which is great. So thanks, Charles. Good morning. Joel and team, randoms I know, but wondered if your podcast could possibly do a chat on investing in stocks whilst they're slumping right now. Would love to have expert opinions on it. General in nature, as always.
Seek not expert, general.
Seek personal financial advice and whatnot when it comes to your own situation. So general in nature. So, it's just topical because we're talking about it now, and I think, the key word slump there is, when is the slump, or how does the slump work, and what's a slump? Is it ever the right time to buy? And they're the interesting things that I think people always go through when you talk about emotional investing. That's really what it's all about. And I think the key thing, I guess, talking about the Munger and the Buffett situation, is they are consistent and quite methodical in their approach, and they have been for over 50 years now. And they probably do take the emotion out of it to an extent where they're just really looking at the company and what it's doing and how it's doing, irrespective of what the broader market's kind of going crazy about. And they've done that historically. And I think, the interesting thing about when you read about Buffett, he's in the same home that he was in for so many years. He paid himself a minor salary, and he lives within his means. They're all things that are just, I think that's just him in general. There's some pretty cool books on that. I think there's one called Good to Great, talks about companies, and generally that CEO that's done that is a very kind of easygoing.
Tim Collins, good book.
Yeah, it's sort of the characteristic of the person or the individual that took that company there. They're always quite an unassuming person, and they're understated. And Buffett is that way. It's not the reason he's gotten rich. The reason he's gotten rich is very, very smart guy, very consistent, very methodical.
People always also forget about that, Joel, which is like him, Charlie, and his team are some of the smartest, financial analysts in the world. So there is that.
Yeah, super smart guy. And he's just methodical and, unemotional, I'd say, to an extent as well. And he just keeps on doing the same things that he's done for so long. And he's consistent, and not, no one around the world, or, very few people are going to be as intelligent or has as much information that he has. But you can definitely adopt the methodical, consistent approach to your investing skills and skill set. And even timing the market. Timing the market is the hardest thing to try to do in the world. When's the slump going to be? But you can control your controllables by doing things like sequencing risk, which is, getting in at certain periods over a time and slowly apportioning your money into an investment to help smooth out those returns over time. There's a lot of things you can do to help yourself in regards to that, because it's very, very hard to pick the bottom. It's very, very hard to pick the top. But if you're methodical and consistent, which is one of Buffett's characteristics and traits, that's one thing that can go a long way to help you remain unemotional.
I think, for me, when I'm looking at that question, you look at, we may be heading into recession, we may be heading into a bear market, these sort of things. There's obviously, we're in a high inflationary environment worldwide. Interest rates are going up, and we'll touch on kind of what's happened in the US over the last week there with their 75-point raise earlier this morning in Australia, but over there is, I think, risk tolerance is a huge thing during these times. So what is your individual risk tolerance? How much are you willing to lose? Don't make any moves that you can't afford. Don't play if it's not in your DNA. So don't force things just because you feel like you need to buy at the moment. I think that risk tolerance one is something personally, because sometimes, and I'm sure we've all done it, you go, oh, okay, I should do that. And you're like, nah. And then you see it play out over 6 or 12 months, and you remember the ones that you would have killed. You don't necessarily remember the ones that you would have slumped, right?
The old FOMO, fear of missing out. Everyone's getting a win. You would have seen so much of that with crypto and the market.
Everybody talks about the wins, right? Not the losses. So it's like gambling in a way, right? You remember the wins and not the losses. So risk tolerance is a huge one. So play within kind of your own budget, your own individual or family investment goals are. So that's one. Anticipation is one for me, which is, for instance, I've got a personal opinion and have held it for a good 12, 18 months that, buy now, pay later companies are going to probably, face some headwinds in the coming times. And, they're facing headwinds in the current times, running down 90%. For me, if discretionary spending is going to get less and less as inflation kind of rises and interest rates come out. And so, what companies are going to get hit more by that? And so start looking more at value stocks. Personally, again, generally nature and the rest of it, I've got opinions on where real estate's going. So if I was looking to invest into real estate or stocks or whatever that relate to it, I'd probably hold off and kind of wait a little while for me perspective. So I think anticipation is trying as much as possible, whatever kind of fields or types of companies or things that they do that interest you, that you want to read up on. I kind of recommend doing that and learning a bit about what these companies do. And I think monetize fear is also something. So if you think that you anticipate that something's coming and and you look at the companies and you work out whether it's based on, PE ratios or price to book or whatever it is that you think, great. And you anticipate something company, don't kind of, anticipate fear. So, if there's a good buying opportunity, jump in. And like Joel said, you don't need to jump in all at once. I think that's the key. So, for me personally, there's some companies I'm looking at. I'm probably personally going to wait until I start seeing inflation numbers kind of not necessarily drop, but start kind of not necessarily growing at the rate that they are. Because I, personally feel like there could be some more drops. I'm not going to try and time the market. I'm just going to try and kind of go, okay, well, this is what I believe in, and I'll start investing a little bit over time into those areas, but not all. And I think carry cash during these times is king. A lot of people are like, oh, you would have lost money due to inflation, but I would have lost a lot more money if all my money was in crypto and stocks. So I'm happy to take my 6% loss, 7% loss, 8% loss on my cash at the moment. That's me.
Always leave yourself a bit of a buffer.
So just to refresh, Chelsea's question was, what do we think about buying stocks while the market's in the slump? Was that right, Jolie?
Yeah,
basically.
Yeah, so I guess the boys are giving you some good sort of high-level general advice. Brad was sort of touching on something practical there. I think the best way to think about whether a stock looks attractive or not is to apply some sort of framework. And the simplest and best framework, I think, for anyone in the market, and I don't know, so I'm not presuming to understand Chelsea's experience or anything, but the one that I always come back to is value investing. And I think one of the best depictions of value investing is done by an author called Phil Town. So if you wanted to get like a practical guide on how to value a company, it's a really easy starting place, and he gives you all the steps. So he's got 3 books out and a podcast. The books are called Rule 1, Payback Time, and Invested. Invested is a book written by his daughter, and it's based on their podcast. So I think the podcast's on Spotify. But long story short, they talk about the 4 M's. So they talk about moat, which is, what is the brand's thing that makes them unassailable by their competitors. They talk about management. They talk about meaning to you. So is it in your circle of competence, like Buffett would describe?
Your interest, right?
Yeah, well, it doesn't even have to be your interest. It's, can you understand it, right? Like, can you pick up like something about the company and go, oh, okay, I understand this. That's your circle of competence.
I guess if I'm not interested, I get personal. If I'm not interested in saying, I don't want to kind of learn about it.
Well, the way that Phil Town would describe it is he puts 3 circles. It's basically like, how do you earn money? How do you spend money? And I forget the other one. Maybe it's interest anyway. But long story short, he's got hacks for how you do the meaning one. And the 4th M is margin of safety. And that means buying at a 50% discount to whatever the fair value is that you ascribe to it once you've gone through the valuation process. So what would I be looking at in a company right now, Chelsea? I'd be looking at cash flow, strong cash flow for owners, the return on invested capital. I'd be looking at their sales growth over 9 years, 7 years, 5 years, 3 years, 1 year. I'd be looking at earnings per share over the same time periods. I'd be looking at equity, and I already mentioned cash flow for owners. And then once I've done that, I would look at what I expect to get, like the rate of return for that company based on some of those metrics. And then I would apply the margin of safety, and I would do a valuation. So we as a channel do plan on maybe doing some sort of doing a few things.
I think like a good explanation video on like how you value in the model. I can even throw my model across, would be good.
Yeah, I think, well, you and I can like have a think about that, but just for the moment, I don't want, because I don't want anyone to wait for us to do it. So you can go, and there's heaps of YouTube tutorials about this kind of thing as well. So because you want to take advantage of the market right now, Chelsea, and anyone listening, then fair enough. So what have I invested in? This is general in nature. I invested in a company pretty recently, which was Magellan Financial Group. It's on the ASX, and they are basically a company that aims to invest in the world's best companies. And they've taken a huge hit because they invest in companies like Facebook, Netflix, Alibaba, Tencent. I think, yeah, exactly. So they've gone like really, they've taken a huge hit, and it's almost like catching a falling knife, as they say, because from when I bought, they're already down another 15% or so. I can't remember exactly.
They also lost their key CEO and chief investment officer, Hamish.
Yes, they did.
Well, yeah, a bit of a meltdown.
And they also had some of their biggest clients pull huge amounts of funding out. So, but I mean, this is all like, and I feel for that dude Hamish, and he's obviously a great stock picker and has been over the years.
I think he's recently just come back on as a consultant again.
Yeah, well, that's positive news for them. But what I mean is, like, I look at that company. I went in and looked at their annual reports. I looked at their financial position and how strong they are. And also one other thing I might mention is they pay a very high dividend. And I feel like when you're in a market that's slumping, getting big yields like that from places is one of the best things you can do, because it allows you to keep reinvesting and keep refreshing that cash position that Brad and Joel talked about, because you don't want to just dump it all in at once and then find yourself in a scenario like me where you're down 15, 20%. Because, if I love this company 15 or 20% ago, I love it even more now. So I want to be able to dollar cost average in a little bit and buy as time goes on, because no one knows if it's going to go up or down. But what Brad and Joel have said is prudent is that, if CPI doesn't flatten out, if CPI doesn't drop, it's likely that interest rates will rise, and our interest rates in America will rise. And then Australia will follow suit, because they want our currency to stay relatively strong versus the American dollar. So that will cause stocks in our market to drop, as we've seen over the last couple of days. So long story short, I would look at some of those things I mentioned regarding field count and value investing. I would look at how to value a company, and then if you find a company you like that's hitting those metrics that I mentioned, or ones that you find yourself, and invest in it. And don't be afraid to dip your toe in. But I would caution not going all in at once.
Yeah, and for those that aren't as keen on wanting to necessarily dig into that detail for specific tops, whether they don't have the time or the instinct or the want to do that, there are a myriad of different options of index funds and ETFs and whatnot that have market segment, and you can sort of select to say, okay, well, maybe I'll set up a portfolio in this area here and just have the index work for me and dollar cost in that way. And that saves the time if you're not that way inclined, because not everyone is. We see all different types of people in the advice world, and some people are busy doing their professional day-to-day jobs and don't have an interest in doing that. So there's other options. There's plenty of options out there for people to do their certain things that they want to do. Now, I was going to share screen quickly because it's a great segue that you made, Arnie. There's just a bit of inflation numbers that I was reading before. But this one here was a graph that I got handed by a colleague actually the other day, and I'll have some cool graphs that will come in to next week's podcast as well that are quite interesting with the current environment. So this is just as time horizons grow, equity losses fall off. So the probability of negative returns based on S&P 500, which is the Standard & Poor's top 500 companies in the US, total returns from 1929 to present. So if you're invested in one day, you've got a potential chance of a 46% negative outcome. Then you've got 1 month, 1 quarter, 1 year, 3 years, 5 years, and 10 years. So as your time horizon maintains in a portfolio, your chances or probabilities of a negative return drop off dramatically over a period. So that's what we talk about when chopping in and chopping out of investments in terms of making emotional decisions can sometimes work against you when you are investing, because investing is a long-term play and a long-term gain. So that was just an interesting probability of negative return if your time horizons are a certain amount there in the S&P 500.
Yeah, that's very informative, and I think we always bang that drum, and I feel like it's just a really good way to do it. Like, it doesn't mean you shouldn't be thinking about selling your companies if they 10 times or whatever, and the valuation looks like it's overvalued. Like, that's why I was saying before, you need to be constantly monitoring it. But at the same time, in periods like this where there's extreme fear and people have seen their portfolios drop by a lot, the psychology of a human, you start to think, oh, I should take my money while I've got it. And then you might be blundering. You might be making a big mistake, but who knows? And
for those listening to us that aren't watching on YouTube, apologies. The graph is essentially showing holding an investment for 1 day is a 46% chance of a negative return. And the graph slowly goes down from 1 month to 1 quarter to 1 year to 3 year to 5 years, from 38%, 32%, 25, 16, 10% for 5 years, and a 6% chance of a negative return for 10 years. So for the listeners out there, if you weren't watching us on YouTube, apologies. But we'll try to put it up on the channel too. And I'll have some more cool slides next week, which we'll go through as well.
Does that mean that 54% of days since 1929 have been up days?
No, it means that if you only held for 1 day, there's a 54% chance you lost money.
Wasn't it 46?
46% chance.
46%.
Yeah, so 54% chance you made money. Which means
but only if you held for 1 day.
That's what I mean. So if I bought every single day.
And then sold in the same day.
Sold the same day.
Yeah.
I'm up 8%, Arnie, from losses.
Okay.
I'm just joking.
The brokerage buy sell
just stuffing around. Yeah, my broker is not so good there. Damn the spreads.
Yeah. I think historically it's like 70% up markets, 20%, 29, 71 up markets, 29 down markets, something like that.
I've got 34% down markets. But yeah, I mean, same. I think that kind of, the question kind of leads itself into probably, what's going on in the Aussie markets this week? What's happening in the crypto markets? What's happening in the international markets? And I think the big one is that we can talk about is the US CPI number was higher than anticipated, 8.6%, showing that it's still gaining by the most since 1981. And subsequently, Jay Powell came out and did what probably most people probably thought, which is he should have done 100, but didn't want to fire the bazooka too much and scare the market, so he did 75 instead. Markets responded initially very positively in the US after the actual announcement today. I don't know where things.
Yeah, I think they finished up about 300 points.
Don't know where the markets, but
Yeah.
subsequently, I mean, the inflation rate was announced last week, and so we had this in-between period where the US markets tanked on inflation data on Friday, which is our Saturday, and our markets were closed Monday.
Yeah.
And so we had a bit of a bloodbath this week until we got a bit of an idea around what's happening around around interest rates. And I think, you know, the key things there are a few things, which is they fired 75 basis points. They're saying another 50, 75 should be kind of expected. Next, and then a bit of a wait and see. We had our Reserve Bank come out and say they believe that we'll hit highs of about 7% inflation by the end of this year before easing in first quarter and coming down in the second half of 2023.
Yeah. And I think they will get that inflation number between, for the listeners out there, between 2 to 3%.
Is the RBA's long term, yeah.
Yeah, and the governor, Philip Lowe, mentioned that it's reasonable that the cash rate may get to 2.5% at some point. And he sort of says that, you know, that because the midpoint of the inflation target is 2.5%. So if an interest rate gets 2.5%, inflation adjusted terms is a real interest rate of 0, which in historical terms is quite a low number. So to expect that over time, they'd get an average inflation adjusted interest rate a bit more than 0. How fast it gets to 2.5%, he says, and whether we get there will be determined by events. So, you know, the events he talks about, you know, some of the events are a bit out of our control, such as external factors, and that's the reason the inflation's now expects to get to 7% is because of wars in Ukraine and global supply issues, which we've spoken about a number of times before.
And I'll talk about kind of gas in a bit more when we talk about news. But I think, you know, the key thing to kind of realize about where we are at the moment probably is we're still in this kind of what I call the finding out phase. I think the world is trying to kind of, the world's woken up to inflation. They're trying to tackle it. They know kind of what's causing it. I wish kind of more governments would probably focused. I mean, the problem is that some of the structural reasons, underlying reasons for the symptom of inflation or the outcome of inflation takes a while to fix. Supply chain, supply side and the logistics side and the rest of it. So, and we're in a bit of a different world like we talked about last week. So it'll be interesting kind of just, we're in this phase of, you know, QT and trying to get inflation under wraps. And so just again, going back to kind of the question of the audience member, that's kind of just where we are. So you've got to take that into account when we're still in this kind of who knows when and what is going to actually peak and what number it's going to be. And then subsequently, the higher it goes, the more impacts it has onto different things like, you know, cost of debt, on, you know, cost of living, a whole bunch of stuff. So, and that affects companies as well.
The market broadly, like the stock markets broadly, are a very, very early forward leading indicator of what they expect the economy to get to. And it's usually 6-12 months in advance is what they're thinking, if not a bit more, in terms of what's the traders and what's the floor seeing play out 6 and 12 months in time. So they're sort of seeing and factoring these things in. So, you know, once, you know, that's what I mean about making your decisions around a stock. You know, that's why you want to make your decisions around with the investment philosophy you're having, and have that as that kind of you know, time frame that you want to be in something quality for that period of time, because it meets all your criteria. But if you're trying to sort of pick stocks or do certain things, the markets factor things in well in advance, and
depending on outcomes, right? So if the market's factoring in 75 basis points and it did 140, would indicate, okay, well, it's way worse, and then they'll jump down even more. But if they kind of inflation numbers came back at, like, let's just say 6% and showed that, oh my God, we've already turned it down to 6 or 6.5%, just on what we've done now, the market would completely react to that and stuff would start bouncing quickly.
Yeah.
It's that, and that's why you can't really try and pick what the market's going to do, because the market's just betting on outcomes. And just like sports gambling, you can believe that, you know, the D's were going to beat the Pies, but they see what I did there, boys.
They were rubbing it in there, mate. Just a little subtle rubbing it in.
But they did it. And, you know, and then things adjust. So I think we're on our way to equal 5th place now. But go Pies. That's why just don't like. I think like what Joel said is that the market is trying to bet in what they think is going to happen, and then depending on what actually happens, the market then knee jerks one way or the other.
Well, it's an interesting example from the FOMC meeting where Fed Chair Jay Powell spoke, because you mentioned just before, Brad, that he basically said 75 next month as well, 75 basis points. But I think on my reading of it, he was saying if required, and he also tempered it with saying like, do not expect 75 to be like a regular occurrence. He doesn't want it to be 75.
I read that too. Yeah.
And people were speculating, like, once it happened and the market pumps, people were like, well, why? Why is it, isn't this negative that, people thought it would be 75 basis points? It is 75 basis points. Why is the market going up? And just as an example, Tankers, speculation is that when that occurred, people who were short the market had to cover, which then drove the price up, but then into the close, it came back down a little bit. Speculation that algorithms took over the trading as soon as the short covering was done. And then as that news filters through in the next couple of market days, it's probably likely that we're going to see the stock market come down, because those interest rates are going to affect bonds. And when the bond yields are going up, the stock market's going to come down.
Because capital flows, right? People kind of go to something safe when the bond yields are up.
Exactly.
And so that's what, like, there's a lot of moving parts. So back to our point, do conviction and value investing and look at it. Don't try and pick the bottom.
Yeah.
Stock markets are irrational.
Yes, they are. And like, there was some bits around like, okay, well, if he's done 75, if he'd done 100, would the market's actually responded even more positively to that in a way where, they're taking a stronger approach and there's going to be less ambiguity and it's going to have a quicker effect, and therefore returns are going to come back quicker. Who knows? There's a whole bunch of people out there betting, guys, and don't try and get caught up in betting.
I think one of the overarching thing with, putting my advisor hat on is there's a lot of noise and a lot of things that happen daily and weekly and monthly. The best outcomes over time, or some of the most consistent outcomes, come over time when you block out the noise, you don't get emotional, you don't try to pick the best, worst, what. You're consistent, methodical over the longer term. That noise and that daily stuff, yes, it's great to have a podcast with, it's great to talk about because it's newsworthy, but over time, that kind of consistency approach will actually end up being quite a strong approach for you to take, because the market's sort of like, the market's like a boy with a yo-yo. The market is the undulating hill going up over time. The boy with the yo-yo going up and down the hill is the weeks and the months, and the actual yo-yo is the daily up and down. It becomes less and less relevant, the days and the months, as opposed to that big mountain that is essentially getting climbed over time.
Yeah, and I think I've been saying this to a few people over the last couple of weeks, how amused I am about how much noise there is, right? Because this has been coming. I was just speaking this morning to a couple of big PE funds in the US, and they've got 20, 30, 40 bill under management, and I was giving them a bit of grief because I've been speaking to them on a 3-monthly basis, and about how funny it is how, January, February this year, I was having conversations and saying things, and the same people were across the table from me saying, oh, no, 12 months, what can go wrong? Yeah, we'll probably inflation, there's probably these problems, but it's not going to be. And then bang, right? It's just, and then suddenly the news cycle grabs it, and suddenly all this noise, right? And so when the noise is happening, try and ignore the noise, because it's generally, not what's actually, where we're actually heading. So I think that ignore the noise, Joel, is a really, really important one, because at the moment the news is just full of it.
and not knowing like how bad it was going to be. Like we knew inflation was coming. We did a podcast about it, like we spoke about it, and at the time, my general thoughts and feelings were, okay, just invest in real assets. But then who could have foreseen the war between Russia and the Ukraine? And how much that would have exacerbated the already
and the timing of the war, I think, is the
exacerbated the already existing supply chain problems, and then like everything.
Just as markets were recovering, just as sentiment was recovering, so no one can, right?
No one can.
No one knows the short term. No one can tell, and that's where consistent, methodical.
Let's get some insights to Putin.
You're putting money into your investment. 5 years, 10 years, 15 years, those kind of things become less and less relevant to your overall position. And there's a pretty cool graph I'll show next week. I remember I was watching a slide recently at a PD day, and it talks about when you have your worst kind of days in market. We had a really bad day on Tuesday this week. it's usually followed within that month as one of the best days in the market. It's really interesting. So I'll show that graph next week to the listeners out there. So
just a screwy sentiment. I just think that like when the news and the cycle start and everyone gets on the bandwagon and all the rest of it, everyone loses sights around kind of, okay, well, what's next? Because what's happened, what people are currently focused on is what's been happening, right? For the last and finally they've caught up. The mass market's caught up. It's got, okay, well, then where's it heading? So ignore the noise and kind of start focusing around where things.
Now, do you want to go through a bit of crypto stuff?
Why not,
Brad? And hopefully that helps, I guess, give the viewers a bit of an overview and an understanding of the different themes around investing just more broadly, and how inflation comes into play and how interest rates come into play, and your short-term, your long-term approach, and everyone's approach is different. And any questions off the back of that, feel free to hit us up on any of the means necessary, examples, channels, or messenger or email, whatever you want, you can hit us up.
Oof, talking about bloodbaths. Crypto. I think we called it last week saying I would be jumping in at the moment. And again, who can guess what's going to happen? This week, I guess, where are we at? Start off as we usually do. Bitcoin sitting around 22K, as low as under 20K at one point, down from 30,000. So down 24% over the last 7 days. And Ethereum down over 30% over the last 7 days. And so the markets have tanked. And so I guess, going to a bit of news. One of them, the first one is inflation numbers. So when inflation numbers started coming out last week, they're correlated, crypto's correlated, highly correlated. I think I've talked about this before, to growth stocks and tech stocks. So a lot of the buying of crypto in 2021, 90% of it was actually institutional investors. And so they're highly correlated, and inflation data hit markets and hit crypto. The other big news story, though, was, so we had Luna, obviously, and now the crypto world, one of the biggest players, if not the biggest player for the listeners in, I guess, the DeFi space, decentralized finance space, was Celsius Networks. Jolly, Arnie, you've heard of them or not?
No, I haven't.
I've definitely heard of them, and probably because of the infamous money manager that works there more than anything to do with crypto.
Yeah.
I was going to ask a question as well, Brad, with Bitcoin, I guess, more so as a alternative asset class, as a differentiator against, the market. That was kind of, I guess, some of the thought pattern around it.
Look, past. I got it wrong.
What are we seeing? What do you think you're seeing with it now as an alternate or an uncorrelated or a less correlated asset? Or are you seeing now, and is the market seeing that it's probably more correlated to?
Yeah. So what happened was, I guess, and me included, I was big as a hedge against what I thought was coming in the markets. So I kind of invested a large percentage of my portfolio, not all of it, but a chunk, back in 2021, June. And some data came out more towards the end of last year. I think it was a Goldman Sachs report that showed, so 2020, 87% of all crypto purchasers were retail investors. And then in 2021, like I said before, over 90% was institutional investors. And what that did was kind of time it to the market. So you had hedge funds that were trading in equities in different asset classes and included crypto in the asset class. So anytime they needed to rebalance, reshift, pay off stuff, pay off shorts, whatever it is, whenever the markets dipped, it became just completely correlated. And so it wasn't following correlation. And then over the last couple of years, it has started to follow basically the NASDAQ. I mean, there's been a couple of days where it hasn't, but overall trends, it's kind of following your growth stocks. And not really, the whole concept behind Bitcoin especially is it was supposed to be a deflationary asset class in that it is limited supply. It's not unlimited. And the thesis was that, the financial market, the financial fiat currency and the rest of it, the printing of it and the rest of it was not good for markets, and believed that it was going to kind of, ruin things. And we needed to kind of create an alternative asset class. And so that's like the non-conspiracy version. It was actually like the model of itself it was a deflationary asset. Ethereum, at the end of the day, when they introduced burning, to kind of keep, so the amount of Ethereum created versus the amount of Ethereum burnt actually turned it deflationary. And so while the concept of it was that, and it kind of technically still is, Joel, in terms of its principal design, because it was bought by institutional investors, and kind of that's where the majority of the buys were, where it really rocketed. We're just seeing it kind of correlated. I personally think it's still going to be correlated with the markets, and I think it's personally, again, going to be non-correlated at some point over the next 2, 3, 4 years, as kind of things work themselves out. Whether it jumps back up ever like to where we were, who knows? But yeah, we're seeing a high amount of correlation at the moment.
For the listeners out there, the reason around something that's, I guess, beneficial of having uncorrelated assets or an alternative asset is that not everything moves in the same direction at once, where your portfolio is fully subjected to all the downturns, or your portfolio is fully subjected to all the upturns. You've got a differentiated approach, which means you've got diversified assets, which means if you have to sell down or adjust your situation or whatnot, you've got some assets that are in upwards direction, so you're not taking potential hits, and they're not all moving in the same rhyme or reason, which inevitably helps smooth out a portfolio return for you. That's sort of one of the reasons people like alternative assets or something that's less correlated, so you're not kind of matching everything up, moving the same direction.
Correct.
Even though it looks pretty bleak for crypto, I think like this is like, for me personally, and generally nature tankers, like this is the time where I'm really starting to look at it and thinking, like, if it comes down a bit more, there are certain ones I want to buy. And I've always been a crypto skeptic, apart from SHIB, which is the god of all crypto.
I've always been down there in 16th place, if you're looking at the graph.
Yeah, but this in real talk now, I think like and Brad has said this before. I think Brad said it on the very first podcast he ever came on to explain crypto to us in greater detail. Most crypto is junk. Most crypto are non-productive assets, but the ones that are attractive, in my mind, is still Ethereum because of the smart contracts and what they're trying to achieve there. And ironically, I think SHIB could be actually a good one if they build on that platform to actually try and become the most currency-like of all the cryptos, as opposed to an asset like that you hold. And there's obviously other use cases, and Brad would be across more of them. But
I mean, Honda came out this week with Tezos. You've got companies like the biggest shipping companies in the world team up with that. You've got ADA. There is a use behind, not all and not the majority, but between the high quality ones, there is a use that companies are seeing, and we're at the infancy stage of it. And I think a big part of their desire to own them recently was because of an inflation hedge, and that's why I bought it, and I was completely wrong, due to its design. But I do believe, Arnie, that, again, my general advice, not in nature and the rest of it, I personally wouldn't be buying again right now, because I believe that it is correlated to the markets, and I believe markets have further dropped. That's just me. But I do believe that if we have another leg down from where we are at the moment, I think it's, depending on the quality of the crypto, myself looking at Bitcoin, Ethereum, obviously Cardano, I'm kind of not big on Solana anymore, Polkadot, which is one of the Ethereum. So Ethereum and ADA, for those who want to do a bit more research, were two of the three founders of Ethereum. So Ethereum was created by three guys. Vit stayed at Ethereum. George moved to Cardano and did his thing, and I forget the guy at Polkadot. And so you see them all of them in the top 10. There's some other stuff out there like Avalanche, number 15, I rate, and a few others. But I think, if you stick to like 5 or 6 of the top coins, there's a place for them where they will I believe, not correlate with the markets as their use kind of separates from the market and the asset class actually becomes a standalone. But, for instance, what I'm about to talk about is the reason why it really has fallen is we've had a kind of another Luna situation in a big kind of, black swan kind of event in terms of in cryptos where Celsius. So Celsius.
For the listeners out there or for people watching on that graph, the last 7 days, is there a way to change that to say a 6-month or a 12-month view?
You can on the individuals. So
it's more interesting to look overall at some of those graphs there over 7 days with a lot of those ones you just shouted out. They all were moving in a really similar trend.
So Bitcoin, a year ago was around the 30 to 40K mark, and now we're down at the 20K mark. If I went out to Ethereum,
but just see that graph there on the kind of the 20 that you're on there. That's what was interesting to see, because 7 days, it's been a pretty bear market 7 days. But if you sort of look at that top 16,
and you ignore all the stable coins,
ignore the stable coins, there's a really similar. So
trend. What happens because the asset class? So the whole asset class is worth I don't know what it was, under 973 billion, right? And because the asset class jolly is made up of, if you include Bitcoin, is half the asset class, and Ethereum makes up 150 of the 940. Whatever these two do, the rest of the market largely follows. Okay. And there is obviously altcoin season, and there's Bitcoin, so Bitcoin usually goes and then altcoin. But when Bitcoin drops like that, you'll just see the entire everything drop.
Okay,
yep.
Cool.
Yep. Well, that's just how crypto trades at the moment and has traded for a while.
Great crypto wrap, mate. I'm cognizant of time for the list.
I'm just going to quickly touch on Celsius. I think it's the big one. So Celsius was, for those that obviously believe in decentralized finance, Celsius was the big player. And so what Celsius did was you gave your crypto over to Celsius like a deposit, and basically they gave you a return on that deposit anywhere between 7 and 17%, depending on the crypto, and then they collateralized that and lent that out. So basically, Celsius had 5,100 Bitcoin, 83,000 ETH. They had $750 million in insurance out there. They had $11.8 billion in digital assets under management, of which $8 billion had been lent out as well. So they basically, what happened was people started asking for, similar to Luna, their money back, demanding redemptions, and it exceeded Celsius' liquid reserves on hand. And so the lender was forced to start unwinding its positions. And so you kind of saw this. And if I went to 7 days, 1 day, I'll go to 1 month. You saw this happening late last week. So Celsius went from about 80 cents all the way down to 20 cents, in which they actually froze withdrawals. So last Friday, Celsius froze withdrawals. So I've got friends with $250,000 worth of Bitcoin frozen in Celsius, watching the market of Bitcoin go down and not be able to sell.
Yeah.
And so this was another kind of whale run on an institution to test its liquidity, because that's the market. The market likes to test things, right? And it has bounced back up because Celsius were able to, I think they've sold about another $150 million worth of crypto that they have in DAOs and all the rest of it. But it just shows the volatility that the industry is still very, very new. Hex came out and offered to buy their collateralized loan book. Again, this is something that no one kind of guessed until basically the last week or two. Some people started thinking, well, what happens if the same thing happens from Luna to Celsius? And it caused a run on this. And then the biggest actual VC fund in crypto, I think it was called Three Strikes. Three Strikes, oops. They were the third strike, and they actually have gone bankrupt this week. So that's another thing to watch out. So as kind of the markets go down, crypto goes down, forces certain returns and liquidity events and the rest of it. I think
interesting when you sort of got all your eggs in one basket type philosophy. And it happened years ago in Australia during the GFC with, I'm not sure if you remember, the income funds were an investment that people could put their money into that were...
I agree.
They were sort of sold as similar to a term deposit, but they weren't really. It was kind of, income. They were investing into different areas. As soon as the government came out as an outside external force and guaranteed money in the bank to up to 250K, which is still there now, and it was never even used. It was just to sort of help with people's confidence at the time. then people went to draw from these income funds and say, well, it's not as safe as the bank, even though the bank never even got called on that. They went to cash everything out. This money wasn't as liquid as they needed to be, had to do a freeze on redemptions, which ended up impacting the price of the income funds. So it's time and time again, these sorts of things occur when...
agribusiness was the same thing, pre-GFC. You don't put all your eggs in one basket, basically.
Yep.
Unless it's money in the tank.
Unless it's money in the tank, boys. General nature.
Rapid fire.
I'm in rapid fire. You ready? Here we go, boys.
Yeah, screen or not?
No. I'm just going to read them out.
Cool.
Biden administration planning on more military funding. New tranche to be more than $650 million.
Is that for Ukraine?
No, that's their own funding.
Just 650 million.
Sorry, that's one of the tranches, Brad. So I'm not sure how many tranches.
They're up to 800 bill a year. So what's another 650 mil?
Elon Musk said he would likely vote for Ron DeSantis for president in 2024. And for anyone that is not familiar, he's the governor of Florida who has been in the stash with Disney over many different
the right
things.
loves Ron.
Yeah, they do. They really.
Ron's like a less crazy version of Trump.
That's a really good way to describe him. The GM, so General Motors CFO, has said that they are still in line with their targets and trying to increase vehicle production by 25 to 30% year over year. They have not seen signs of weakening consumer demand, so that's interesting. They also said they'd be able to offset $5 billion in higher costs with higher prices and cost cutting. Biden has informed Zelensky that the United States will be providing another $1 billion in security assistance for Ukraine, and also an additional $225 million in humanitarian assistance to help the people inside of Ukraine.
So I just love those ratios. 200 million for the people, $1 billion for weapons.
Yeah, is it $1 billion in weapons? I don't know, but it's anyway. In similar news to the cost cutting, Spotify, and you probably heard this in a few companies, boys, but Spotify has said they're going to slow their hiring by 25%. So I don't know over what time period, but that's a fair chunk.
Coinbase cutting 17%, so 10,000 people.
Yeah, I heard about the Coinbase one as well.
Minimum wages, Arnie? Minimum wages up?
Yeah, minimum wage is up here in Australia. That's not one of my rapid fires though. Fauci got COVID, so I don't know how important that one is, but yeah, Fauci got COVID. And this is an interesting one, and I wanted to sort of end on this one. The EU is going to buy Russian gas in rubles under some conditions. What are those conditions? I don't know.
Because Russia just cut the amount of supply to Germany and the rest of it by 75%.
Yeah, so they're going to pay in rubles, which is going to, prop up that ruble price a bit more. So that's the rapid fire news items today, boys. And
I love your rapid fire segment, Arnold.
Love it, rapid.
And you even managed to sneak in Elon to who you're going to vote for. You managed to sneak in Elon.
I've got to get him into every single one.
I got Elon's email that came out, Arnie, on Q1. Telling everyone.
You're talking about the one where he said that they're going to suffer some pain, but if they really ramp up the other production facilities, they could still come out on top.
Yeah.
That's what I love to see it. As a shareholder, we love to see it. Got to hustle into the end of the.
Got to hustle, bustle.
Got to hustle hard, man. So he also said during the week that he thinks that if the current trajectory continues, that Lucid and Rivian are heading towards bankruptcy.
Yeah, well, that would help him, wouldn't it? There's a couple of times he was heading toward bankruptcy. Let's be honest.
I don't think he said it. I don't think he said it maliciously. People have speculated that he's doing it to drive the price down,
right?
Yeah, but
direct competitors.
But he has consistently said he wants to see them do well, and he's consistently said that his mission is to transform the auto industry to EVs. So it sort of goes.
Consistently love Elon.
Oh, I just feel like he gets a lot of unjust hate.
Doesn't mind to be in the headlines, does he, Arnie?
He loves the spotlight for sure.
Loves the spotlight.
Great podcast today, crew. And just to wrap it up, has anyone got a 50-50 for this week that they like to throw out?
Oh, you've put me on the spot here.
I didn't have one, but I was just thinking of one then.
Oh, if you're to buy crypto, buy Bitcoin or ETH, what would you do?
No, wait. I've got one too. So let's do that, and then I'll throw one at you.
Yep.
So Bitcoin or ETH, I'd buy ETH right now.
Yep. Probably same for me.
Yeah, under nearly $1,000. Yep.
I got one for you, and I'll try and make it quick, right? So shout out to my friend Ryan. He has been looking pretty heavily at Robinhood. And we covered the news last week about how they're thinking about stopping payment for order flow. But that stock has just hit a level where they've got more cash on their balance sheet than what they're valued at in the stock market currently. So just in cash alone, they've got more there than what the stock is currently being priced at or valued at. So if I had to ask you boys 50-50 on the spot, would you buy any hood right now?
So you're saying the price to book ratio, Arnie?
Price to
So
book,
price
yeah.
to book is obviously theoretically be left if the company stopped operations and sold all its assets.
If you liquidated it right now, you'd be earning money, on top of what you bought it at.
Well, they're not going to stop operating, and I don't believe that the people that use hood would use hood or have used hood would use hood again because they've been burnt. So, nah, I wouldn't buy them.
You wouldn't buy them?
No.
Jolie?
No, it'd probably be similar. Yeah. And I think there's some legislation coming out that might work against them. Is that right?
Yeah, there's further context to this argument about how they might be the target of an acquisition, but I actually would. I'm thinking about buying some here because I feel like as a long-term play, even if they don't get acquired, it's a brand name that's sort of become pretty famous, and I can't see them burning through their cash so fast that they're going to be a going concern anytime soon. So the fact that like you could literally pick it up right now, and they've got more assets, than what they're being valued at, and if it were to be liquidated, like Brad said, you'd be actually earning money.
These are 50.
Here we go, Tankers. Perfect investor over, it's perfect.
These 50-50s are way too financy, guys. So how about we go with one that I just thought of then, a 25, 25, 25 to wrap us up. That's
okay.
Quarter. During the current Melbourne climate of freezing cold, you have the choice of ducted heating, a split system, an open place fire, or a Canara, which is one of those, for those people that don't know, a Canara is like a big black kind of thing that sits in the middle of your room, you put wood into, whatever. What's the preference?
Personally speaking, I had a Canara when I was growing up, and I loved it because it's like a fire, but like not open, and you can like turn that fan up. Yep. I live in an apartment, so Canara not so good. So I'd probably pick my split system here, but Canara is my choice.
Canara's choice.
I would choose ducted heating because I've got 2 small children and I want to keep them consistently warm overnight to a level efficiently. So that's what I would choose. But if I was choosing just on like love of a heat source, it'd be an open fire.
Okay. Yeah, I'm thinking I'd like a Canara, but I'm sort of more thinking selfishly if I'm like by myself in a shack or whatever.
Open fire.
Canara, I reckon, just so much more efficient than an open fire. Fire just burns wood too quickly. Canara
is very efficient.
All night.
Let's take it from me, who used to have to cut and stack red gum out of the backyard. I can guarantee you, Canara, efficient.
Love it. Good stuff, guys. Well, thanks for episode 35. Listeners out there, how can they get at us, Arnie?
At Money in the Tank, YouTube, Instagram, Twitter, and Facebook.
Yeah. Is that 4 or 5 in a row, boys?
Yeah, I think that's 5 in a row. I think 30 is when we've been sticking to it. So
I missed one. Yeah, 6. Yeah. But, good stuff. We'll keep them coming through, and keep the questions coming. We love them.
Cheers.
Peace out.